Imagine you're sitting at a poker table. You've been playing the same game for years. You know the rules, you know the players, and you've built a strategy that works. You've gotten comfortable. Then suddenly, without warning, the dealer stops the game, looks you in the eye, and says, "New game, new rules. And by the way, your chips just got cut in half." That feeling in your gut, that confusion mixed with a little bit of panic, is exactly what investors around the world should be feeling right now after a quiet but extremely serious warning from Bank of America. The problem is, most people don't feel it yet because most people don't understand what's actually happening. Let's be very clear from the start. This is not about a market crash. It's not about a sudden recession or some headline event that sends stocks plunging overnight. In many ways, that would actually be easier to deal with. Crashes are visible, they force action, they create fear, but they also create opportunity. What's happening now is far more subtle and far more dangerous. This is about a structural shift in how money flows through the global system. It's about the rules of investing changing in real time while millions of people continue playing a game that no longer exists. For the last 15 years, the environment was defined by one thing: cheap money. Interest rates were pushed down to near zero, liquidity flooded the system, and risk-taking was rewarded again and again. You didn't need to be a great investor to make money. You just needed to participate, buy the dip, hold growth stocks, ignore valuations, trust that the system would keep supporting asset prices. And for a long time, that strategy worked so well that it started to feel permanent. It felt like a law of nature, but it wasn't. It was the result of emergency measures taken by the Federal Reserve and other central banks trying to stabilize a fragile global economy after repeated crises. Now, that era is ending, not temporarily, structurally. The system is no longer on life support, and the policies that once inflated asset prices are being reversed or normalized. Interest rates are higher, capital is more expensive, liquidity is tighter, and when you change the cost of money, you change everything. You change how companies are valued. You change how investors allocate capital. You change what works and what doesn't. This is what Bank of America is really pointing to, not a single event, but a long-term transition that will reshape the investment landscape. Think of it like a slow environmental shift rather than a sudden storm. Nothing dramatic happens overnight. There's no single moment where everything breaks. Instead, the conditions gradually change until the strategies that once thrived start to fail. The old playbook, buying high-growth companies at any price, relying on bonds as a safety net, assuming the market will always bounce back quickly, starts to lose its effectiveness. And the most dangerous part is that many investors won't realize it's happening until years have passed and their portfolios have quietly underperformed. One of the clearest signals of this shift is the changing relationship between risk and reward. When interest rates were near zero, investors were forced into riskier assets to generate returns. Stocks, especially high-growth stocks, became the default choice because there was no meaningful alternative. But now, for the first time in over a decade, safer assets are offering real yields. When you can earn a solid return with relatively low risk, the incentive to chase speculative investments decreases. That doesn't mean stocks are finished. It means the bar has been raised. Companies now need to justify their valuations in a way they didn't before. This is why capital is beginning to move. Not all at once and not in a way that grabs headlines, but steadily and deliberately. Large institutional investors, pension funds, endowments, and sovereign wealth funds are adjusting their strategies. They're shifting away from purely narrative-driven investments and toward assets that generate consistent, reliable cash flow. They're looking at infrastructure, energy, commodities, and essential services, areas tied directly to the real economy. These sectors may not be exciting, but they are resilient. They function in both good times and bad, and they benefit from an environment where real assets and tangible value matter more. At the same time, another critical change is unfolding. The traditional balance within portfolios is being challenged. For decades, investors relied on diversification between stocks and bonds. When stocks struggled, bonds typically provided stability. But in a higher rate environment, that relationship can break down. Both asset classes can come under pressure simultaneously, removing a key layer of protection. This forces investors to rethink what safe actually means and how to build portfolios that can withstand different conditions. What makes this entire transition so difficult is psychological. Humans are wired to rely on patterns. When something works repeatedly, we assume it will continue working. It creates a sense of comfort and predictability. But markets are not static, they evolve. And when the underlying conditions change, clinging to old patterns can become costly. The biggest risk right now isn't volatility, it's complacency. It's the belief that the environment will revert to what it was, that the same strategies will start working again if you just wait long enough. Adapting to this new reality requires a shift in mindset. It means moving away from short-term thinking and focusing on long-term value. Instead of chasing trends, it means asking deeper questions about the assets you own. Does this business have pricing power? Can it maintain margins in a higher cost environment? Does it produce real consistent cash flow? Is it essential to the functioning of the economy? These questions may not be as exciting as chasing the next breakout stock, but they are far more relevant in a world where capital is no longer free. It also means accepting that investing may feel slower and less dramatic. The era of easy gains and rapid growth is being replaced by a period where discipline, patience, and selectivity matter more. Returns may still be strong, but they will likely come from different places and require a different approach. This doesn't mean opportunity is disappearing. It means opportunity is shifting. And those who recognize that shift early have the advantage. Ultimately, the key insight here is simple but powerful. Money is not leaving the system. It's being reallocated within it. The market isn't ending. It's evolving. And within that evolution, there will be winners and losers. The difference between the two won't come down to luck or timing alone. It will come down to awareness and adaptability. Investors who understand what's changing and position themselves accordingly will be able to navigate this transition successfully. Those who continue relying on outdated assumptions may find themselves stuck, watching as capital flows in a different direction. Years from now, this period will likely be seen as a turning point, a moment when the rules shifted and a new investment landscape began to take shape. Some people will look back and realize they adjusted early, that they recognized the signals and adapted their strategy. Others will wonder why their approach stopped working, why the results they once took for granted became harder to achieve. The difference will not be access to information because the information is already out there. The difference will be whether they chose to understand it and act on it while it still mattered.